1. The 2026 Liquidity Illusion, Introduction and Hook. Right now, billions of dollars are quietly exiting traditional equity markets, and most retail investors are looking in completely the wrong direction. The mainstream financial media is feeding you a narrative of a stable soft landing, but behind the algorithmic curtain of the US, European, and Japanese markets, a structural liquidity drain is accelerating. If you don't understand how these global pieces connect this month, you aren't just risking underperformance, you are risking a catastrophic portfolio wipeout. In this video, we are stripping away the sensationalized doom scrolling and extrapolating the hard data. We are establishing a precise, June 2026 global macro framework. We will break down why the historical correlations between the US dollar, euro, and yen have fundamentally broken down, explore the mechanics of how high-frequency algorithms are trapping retail liquidity, and map how to position your capital defensively to capitalize on institutional order flow. Here is your roadmap for survival and growth. 2. Defining the 2026 global macro framework. To navigate this terrain, we must first define our parameters. When we talk about global macro frameworks in mid-2026, we are looking at the intersection of two critical forces, systemic global liquidity and algorithmic market structure. Systemic liquidity is the actual volume of cash flowing through central bank balance sheets and commercial banking systems. Market structure, on the other hand, is the mechanical playground where this money moves, now dominated up to 90% by automated execution algorithms. Our central thesis today is straightforward. The divergence in central bank policies between the West and Japan has created a structural liquidity mismatch that algorithms are actively exploiting. This is creating artificial price inflation in selective mega-cap equities while broader market breadth deteriorates. If you look at standard stock charts without tracking the underlying liquidity channels, you are essentially flying blind into a storm. 3. US and Europe, the hidden capital squeeze. Let's look at our first core pillar, the persistent, hidden capital squeeze across the US, the UK, and Eurozone markets. For the past several quarters, the Federal Reserve and the European Central Bank have attempted a delicate balancing act, holding interest rates structurally higher than the previous decade while quietly continuing quantitative tightening. The topic sentence you must understand here is that the apparent resilience of Western equity indices is a mathematical illusion driven by a handful of highly capitalized firms. When we examine the underlying data, broader market liquidity is severely contracting. In the US, regional banking systems are showing renewed signs of stress as deposit flight to money market funds continues. In Europe and the UK, persistent structural energy costs and sticky wage inflation have trapped the ECB and the Bank of England. They cannot aggressively cut rates without risking a secondary inflationary spike. What does this mean for your capital? The evidence lies in the credit markets. Corporate default rates among small and mid-cap enterprises in Europe have ticked up significantly over the past 2 quarters. This proves that the cost of capital is finally breaking the weakest links in the economy. The wealth is concentrating in defensive cash-rich monopolies, while the broader market foundation is actively eroding. 4. Japan's pivot, the death of the carry trade. While the West is facing a slow-motion squeeze, the real systemic shockwave is originating out of Tokyo. The Bank of Japan has officially ended its multi-decade era of monetary abnormality, structurally raising interest rates and abandoning yield curve control completely here in 2026. The main point to grasp here is that the global yen carry trade is definitively dying, and its unwinding is acting as a massive vacuum cleaner pulling capital out of Western asset classes. For years, global macro funds borrowed cheap yen at near zero interest rates, converted it to US dollars, and pumped it into higher-yielding US treasuries and tech equities. Now, as the Bank of Japan normalizes and the yen strengthens, that entire trade is reversing. Institutions are forced to liquidate their foreign holdings to pay back their tightening yen-denominated debts. This isn't speculative theory. Look at the capital flow data from the first half of this year. Japanese institutional investors, historically some of the largest holders of U.S. government debt, have become net sellers. This global shift removes a foundational pillar of support for Western bond markets, driving yields higher and placing an organic drag on equity valuations across the globe. 5. Algorithmic traps, reading institutional flow. So, how does this macroeconomic pressure manifest on your daily trading screen? It happens through algorithmic exploitation of retail market structure. In a low liquidity environment, price delivery becomes highly volatile and predatory. High-frequency algorithms are explicitly programmed to hunt pockets of retail buy and sell stop orders to fill massive institutional positions. If you are still relying on retail technical analysis like basic support and resistance lines, you are likely becoming the liquidity. Algorithms frequently engineer false breakouts, engineered moves designed to induce retail traders to buy the top or sell the bottom right before the market reverses. To protect yourself, you must shift your analysis from chasing momentum to identifying institutional order blocks. Look for areas where large capitalization pools have consolidated, and pay attention to sudden, high-volume price displacement. This displacement indicates where the true institutional flow is moving. In June 2026, survival means ignoring the noise of the financial news cycle and tracking where the actual volume is being deployed by automated market makers. 6. Portfolio defense, navigating the inflection point. But how do we practically filter these defensive giants out of a sea of 5,000 stocks? We don't guess, we use raw data. If you open up a stock screener like FinViz or TradingView today, here are the exact structural settings you need to input to find assets surviving a liquidity drain. Filter for a free cash flow margin above 15% and a net debt to EBITDA under 1x. This immediately eliminates the debt-laden firms getting crushed by the credit squeeze. To ensure you are riding institutional order flow rather than getting trapped by algorithms. Filter for institutional ownership above 70% and an RSI between 45 and 60. This pinpoints cash-rich monopolies quietly consolidating before the next algorithmic leg up. Navigating this complex global inflection point requires an immediate shift from aggressive capital appreciation to strategic portfolio defense and risk mitigation. Asset class, strategic stance, tactical rationale, cash, short-term bills, overweight, capitalizes on high yields while maintaining absolute optionality. Mega-cap monopolies, highly selective, focuses strictly on businesses with pristine balance sheets and positive free cash flow. Sovereign debt, neutral to defensive. Targets short-duration bonds, avoids long-term yields vulnerable to the yen unwind. Hard assets, commodities, discretionary allocation. Acts as a structural hedge against persistent cross-currency volatility. This allocation strategy aligns your capital with the reality of a contracting global liquidity pool. By protecting your downside today, you preserve the dry powder required to buy high-quality assets at deep discounts when the algorithmic deleveraging process reaches its inevitable cyclical conclusion. 7. Summary and your next critical steps. Outro. To summarize our June 2026 global macro framework. First, understand that Western equity indices are hiding a systemic liquidity contraction driven by ongoing quantitative tightening. Second, recognize that the Bank of Japan's policy normalization is actively unwinding the global carry trade, structurally withdrawing a primary source of capital from Western markets. Third, adapt to an algorithmic market structure that hunts retail stop losses, and shift your execution toward tracking true institutional volume blocks. The fundamental importance of understanding this framework cannot be overstated. We are moving away from an era of free central bank money into a rigorous macro environment where capital preservation is the ultimate edge. Those who fail to adapt will continue to buy artificial tops and get trapped by predatory algorithms. Those who understand global liquidity flows will not only protect their generational wealth, they will position themselves to capture the asymmetric opportunities that only occur during major market structural shifts. If this institutional breakdown added value to your investing process, hit that subscribe button, drop a like to beat the algorithm, and make sure to answer our community poll pinned in the comments below. Let me know your defensive asset allocation strategy for the months ahead. Stay grounded, trade objectively, and I'll see you in the next video. Farewell.